Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, and a very happy new year to everyone. Joe Anderson here, certified financial planner. Al Clopine next to me. 2017 is upon us in a few hours. Can you believe that?
It's right around the corner, isn't it?
Yeah, 2016 was kind of an interesting year, to say the least. Started out the year, the worst January? Worst weeks?
Worst stock market in the month of January ever, or first 2 weeks maybe
Right.
is the exact thing.
And then, here we are, 365 days later.
Yeah.
And the market did all right.
Yeah, it turned around fairly quickly, didn't it? So by, I don't remember exactly when, but it seems like by February, at least mid-February, we'd regained a lot of the losses that were suffered.
I would say
January.
most people forgot exactly why the market blew up in January.
Right.
You know what I mean?
Including us, because it doesn't really matter.
It doesn't. It was China. It was oil.
Yeah,
it was
right. That's what the pundits were saying.
Of course. So I think this year, if you take a lesson of this year, right, 2016, when it comes to your investments, there's a couple key ones I would imagine that everyone hopefully will remember for the rest of their lives, is that it's very difficult to time the market. You know, when you have all that information, we had two huge events this year when it comes to like political stuff. Is of course we had the election with Trump,
right,
and then Brexit.
Right.
And so, those are two major things that happened in a 12-month time period.
Sure.
And we all knew, all right, well, with Brexit, I think a lot of people freaked out because that's a huge, capital hub of the world.
Right.
Is in England. And so what happens when they get out of the Eurozone? And so the market kind of was extremely volatile for a short period of time, but it recovered. And then, of course, with Donald Trump getting into office, everyone said, well, as soon as he gets into office, we'll see a 20% correction.
Yeah, it's going to go way down, and it went up.
Yeah, right.
Quite a bit, actually.
Yes. And then we hit market all-time highs.
Sure.
16, 17, like straight days, something
right.
to that effect.
I know. Dow approaching 20,000 as we sit here right now.
Exactly. So it's with everything that goes on in a given year, right? And then when you listen to radio shows like this, too, I think it creates anxiety.
Yes, I agree with
because the news is constant in your face, and then you're listening to it, and then so you have to react to it, is what you feel that you have to do, right? It's just human nature. When you see a bus coming at you, you want to move.
Sure.
And so when you see big events like this, you want to move either in or out of the overall markets.
Right, you do. And just thinking back a few years, March of 2009 was our market low since the Great Recession. And we got a pretty good recovery the rest of 2009. But remember, everyone was talking about the dual recession, the double recession.
The double dip, the W.
Double dip, the W. It's going to be a W effect, and it's going to be a really low center W, and then it's going to, we're going to be down for a while. But anyway, and then 2011, 12, the market is recovering nicely, right? And so maybe it's time to get out. And we had, I think was it 2012 or 13 where the market was flat? I can't even remember now.
2011. We had a correction in 2011, down 20%, and we were dead flat at the end of the year.
Yes, you're right. So maybe
that's when what would we have?
So that's what I'm thinking is 11. But 2012, 2013, a lot of people got out of the market because of the fiscal cliff and the devaluation by Standard & Poor's of the government T-bills.
Right.
Right, and so there's all these reasons always to get out, and now we're at all-time highs, Dow 20,000. So surely we should get out.
Yeah, but I mean, if you take a look at the couple-year average of the Dow, I mean, what, 4.5%, something like that. So I mean, you hear this all-time highs, but yeah, that's what the market does. It always hits all-time highs, and it takes a little bit of a correction, then it hits all-time highs again. That's what a bull market does.
That's supposed to do, right?
Yes.
It goes up over time.
Yes.
Right. So I guess the point of all this is just going back in recent history. All kinds of things have happened, and the market has survived and prospered. and there's no reason to not believe that will continue to happen. Now, could we predict that 2017 will be a great stock market year? Absolutely not. But if you look at over the long term, and that's what I think investors need to do. I think they have to look at the long term and not worry about the day-to-day, month-to-month, quarter-to-quarter, because if you've got the right investment allocation for you, then let that thing go.
Right. Well, the problem is I think sometimes, too, people don't have the right allocation.
That's true. I mean, so there's a little work to get there.
Right.
Certainly.
There's recency bias in a sense of, all right, well, this asset class performed well over the last couple of years, so let's overweight that particular asset class.
Sure.
This asset class didn't perform as well, so why do I want to continue to own that?
You might want to do just the opposite.
Right. So they might feel that they're diversified and they're tweaking their portfolio to enhance it, but actually they're hurting themselves.
Yeah. Sometimes, Joe, though, even when people know they got the right allocation, maybe they're working with a great advisor, and they still question. It's like, shouldn't we get out? Because the way that the financial media press talks, it's so dramatic. It's like, this is going to happen, and so therefore get out, or this is going to happen, so therefore get in. And you can listen for several hours straight to something like CNBC and get 8 different opinions, and then you just end up confused.
Yeah, I think most of the pundits are confused.
Well, they certainly don't agree, do they?
Well, that's how they get compensated too.
Right.
They get compensated to make predictions.
They do, and when you happen to get one right,
you bank.
You make some money, right?
Right. Then you go on a boat tour.
Sometimes it's the more outlandish predictions that people want to make, the pundits, because if they get it right, they're the expert for the next 5 years.
Right, and the more outlandish you are, the more likelihood that you're going to get on a TV show, a radio show.
Remember Nouriel Roubini, who predicted the black swan, and so they say he predicted the market crash, and so he was on every show for about 5 years until they found out all his other predictions before and after weren't true.
Right.
They didn't come to be true.
Yeah, didn't come to be true.
Yeah.
So, I was listening to a very well-known financial expert, and it was kind of interesting to me how people kind of double talk a little bit.
Yes, right. They kind of say something totally different than what they said the day before.
Or just a minute before.
Or a minute before.
So he was talking about 2016 and a very similar conversation that you and I are having, Alan.
Okay.
And was going through, all right, well, the best advice possible is that you want to stay invested.
All right.
Because if you get in and out of the overall markets, since the election till today, the market's up, 10%, let's say.
Right.
Don't take my word for it, but it's up. And so it's like, well, those of you that set out in cash because of the election, right? And then you got in, you missed a huge run, and these runs happen in 4 or 5 days.
Sure.
And so when you're sitting out, right, you're going to lose the major component of that overall year's return by making the wrong moves.
Right.
And so I was like, yeah, that makes a lot of sense. I agree with that philosophy. And then he went on to talk about Brexit, right? And so he just went through like this full, disciplinary investment approach, have the right asset allocation, rebalance, tax manage, don't get freaked out.
Okay.
And
good advice.
Yeah, right. And then it's like, all right, well, then he talked about Brexit. He goes, well, I was at the gym, when the market was tanking. And so what I did is, I actually bought, I bought a lot, on the dip. And then I'm thinking to myself, all right?
That's 2 different strategies.
So if you have a fully invested portfolio that you are rebalancing, right?
Yeah.
So all of a sudden when the market dipped at Brexit, then all of a sudden you bought into the market? So that's telling me that you were out of the market, that you had a lot of cash on hand. So which one is it?
All right.
Are you timing the markets and buying on the dips? You've heard that terminology before, right?
Yeah. I heard that at several pundits.
Oh yeah, you got to buy in the dips.
Yeah.
Okay, well then,
when's the dip?
Yeah, when's the dip?
You only know it when it's too late.
And then
that was the dip.
And then what categorizes the dip? And so it's like, okay, well, which one are you doing here?
Right.
Are you fully invested and you're giving that advice, or now are you giving advice to say, well, hey, when the market drops X month, then that's when you get in?
Right.
So and then I think he just wanted to make himself feel like he was smart, the smartest person in the room.
Right.
And I think ego drives a lot of this because money is very emotional. And so it's like, all right, well, you go to the cocktail parties. It's New Year's Eve. I'm sure a lot of you went to Christmas parties, holiday parties, and everything else. And then the word stock comes up. Hey, what are you buying? And especially, too, with Al and I, because we're in the profession. Hey, what do you do for a living? We're in financial planning. Oh, what do you think the market's going to do?
Yeah.
What stocks do you like? it's going through that BS. It's like, oh God.
Yeah, you go to a cocktail party and you get. Well, what do you think of Shell Oil? It's like it's a company.
Yeah, I like it just as well as Exxon.
Strong company. Yeah.
Pretty strong. How's your portfolio? Strong? Yeah. So anyway, all right. Well, hey, we're just getting started here. We got email questions. We got an interview. We got a couple of quick minute tips for 2017. Of course, New Year's resolutions is right around the corner. So stick around. Happy New Year, everyone. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back. Show's called Your Money, Your Wealth. Joe Anderson here. I'm a certified financial planner. I'm with Alan Clopine. He's a CPA. And you're listening to Your Money, Your Wealth. What do you got? You got a couple of different articles.
I do, Joe. And I think this is such a good time of year to think about the future. I mean, a lot of folks at this time of year we're right around the corner of January, New Year's, and it's like, all right, what can we do better in 2017? And of course, certain things come to mind, like getting in shape and eating better. That's typical. But also, how about a financial checkup, and more specifically, a retirement checkup? This could be any age, probably most helpful if you're within about 5 years of retirement, but this could be potentially any age. What are the things that you ought to be doing to figure out, can you actually retire later on? And I've got 8 different things from an article written in U.S. News by Teresa Mayers. Joe, and I think I'd like to go through these and let's comment on them.
All right.
So number 1 is evaluate your Social Security claiming strategies, because we know that you can start collecting as early as 62, but there's downsides there. Your full retirement age for most of you is 66, unless you're born after 1953, I believe.
54, yeah.
I think that's what it is, where it starts. It'll edge out to age 67, and then you can take it as late as age 70. So, Joe, that really is important to start thinking about Social Security even before you get there, because that's going to be potentially a big chunk of income for you.
Well, I think that's the anchor for a lot of individuals when it comes to the retirement income. And as you and I see this every day, is doing this for many years, is creating the retirement income from a portfolio is completely different than saving money into the portfolio, right? And I think a lot of times, what assets are you going to sell? Are you going to have a high dividend stock portfolio to kick out dividends? Are you going to sell some of the principal on a total return portfolio? Are you looking at high yield bonds? Are you looking at an annuity or whatever? I mean, there's multiple different strategies that people might listen to, right? Or they might study, or they just kind of fall into, all right, well, here, I'm just going to sell whatever's up or down or whatever. I mean, they don't necessarily have a concrete strategy. And as we've been extremely lucky since 2009, right? Because the market has been basically going up.
Correct.
But when the market starts to dip and go down, then I think this is where a lot more individuals are going to have some problems. So claiming your Social Security strategy correctly is key, because you can really enhance your overall lifestyle by having that right strategy, depending on when you want to claim it, how many other assets that you have, what's your tax situation, because that's a fixed guaranteed income stream for the rest of your life.
Right. And Joe, I think the basics are full retirement age right now is age 66. If you take it at age 62, you're going to reduce your benefits by about 25% for life. Right? Now,
it's permanent.
Now, if you take that same age 66 and go forward to age 70, in other words, you wait, you're patient, then your benefit's going to be about 32% higher than it would have been at full retirement age. So that's a pretty big difference. I mean, for every $1,000 of benefit that you would get at age 66, if you took it at 62, it'd be about $750. If you waited till 70, it would be $1,320. And maybe your benefit's a couple thousand a month or more.
Right.
And this can be a big deal because in terms of it's kind of what we might call longevity insurance, if you will, because a lot of us are living longer. Social Security goes throughout your life. And if you do live a long life and you do have a higher benefit, then that's obviously going to help you throughout retirement. Also, something else, Joe, is when husband and wife are working, both have benefits, you truly might want to consider pushing the higher wage earner out to age 70 for the highest benefit, because no matter which one survives the other one, the survivor will get the highest benefit, which if you wait till age 70 will be that benefit.
Right. So what I guess in other words is, let's say you have, or maybe they have the same benefit. One person waits till 71, maybe takes it at 66,
sure,
whatever, right? And then the person that takes it at 70, maybe they have a benefit of $3,000. The person that took it at 66 has a $2,000 benefit. a month.
Sure.
And then so the person that waited to age 70 passes away prior to the other spouse. So that surviving spouse takes the higher of the two benefits.
Right.
So that surviving spouse says, all right, well, no, it's not $2,000, now it's $3,000 plus the COLAs or whatever. So it's, again, more like a longevity insurance contract for the surviving spouse. And if the surviving or if the high wage earner is older, right, maybe male, right? I'm not trying to be sexist, but if you look at history, that could be the case, right? So then you have an older male that has a higher benefit. That person should take it out to age 70 because the male will die before the female, and then the female then can take the higher of the two benefit.
We'll get that higher benefit. Yeah, that's absolutely right. So, Joe, another one would be to evaluate your savings. So if you have $500,000 in savings, you probably should plan not to take any more than about 4% per year. And this is a rule of thumb. It's called the 4% rule. It doesn't work in all cases, and I sort of want to make sure I emphasize that. In fact, if you retire younger than 66, you probably don't want to take 4% because you're probably going to run out of money sooner. So there's a lot to the calculation, but just back of the envelope rule of thumb. So $500,000 savings, 4% of that's $20,000. That's approximately what you should plan to take out of that portfolio. And some people mistakenly think, well, wait a minute, the stock market has earned 10% over the last 100 years, so I should be able to take 10% out. Right? So that's $50,000 instead of $20,000. Well, the problem with that is the stock market does not earn 10% every year. Sometimes it loses 20%, sometimes it makes 28%, whatever. Sure. It's all over the place. And depending upon what it's doing when you first retire is going to completely impact your retirement. So you don't want to take that much out. Secondly, you got to have some money for taxes. And third, you want to leave some money in there for growth because of inflation. Right, so it's not just the 10% per year. 4% has been there's been all kinds of studies over time. It's a pretty good rate. It's not perfect. In some cases, people will recommend lower distribution rates right now because our interest rates are low and the market is at all-time highs. Will it do the 10% over the next 100 years or even 20 years? Nobody knows. Right. Nobody knows. But
I think the 4% rule is a good rule as you're accumulating wealth to see what number is appropriate to save to.
Yeah.
Right. Because let's say if you want to spend, you need an additional $40,000, to supplement your Social Security, pension, real estate income, whatever.
Right.
Well, you need at least $1 million in liquid capital to provide that income. And I think just doing that math will encourage people to save a little bit more.
Right.
Because it's like, all right, well, here I have a few $100,000 saved. That's pretty good. But I'm used to spending $100,000 a year, right? Well, the math is not going to work. You will run out of money. So then if you just do the back of the envelope, math of saying, well, 4% rule, so I need at least $1 million to create $40,000. Then once you get to that $1 million and retired, then you have to really concentrate on the strategy to create the income. Because you got, longevity risk, tax risk, political risk, you have interest rate risk, you have sequence of return risk. I mean, there's all sorts of different things that will blow that thing up.
Yeah, and to use your example of someone that makes $100,000 a year, and let's say after taxes they net $70,000, right? So they need $70,000 to continue their same lifestyle.
Sure.
Now, all kinds of financial planners will say you can get by spending less, and maybe that's true. For some of you, maybe it's the opposite. Maybe you want to spend more in retirement. But let's just say you want to spend that $70,000. You're making $100,000. Well, Social Security might pay 30% of your salary, just as a rule of thumb. I mean, it's not true for everybody. So that's $30,000. Okay, you got $500,000 saved. So 4% of that's $20,000. So you got 50 roughly. You need 70. So you're still short, right? So that's the calculation that will help you decide: do I need to save more? How much longer do I need to work? These kinds of things. It's rough. It's back of the envelope, but at least it gives you an idea.
Well, yeah. Well, the average balance of a retirement account is zero.
Well, we know the average balance of 50-year-olds, it's like $14,000. Now that includes all people that have nothing. Right, if you take the people out that have nothing, then the average balance is like $90,000 or $100,000.
Yeah, $100,000.
Which means what? $4,000 of income?
Yep.
It's not really going to cut it for those of you listening to us here in San Diego. It's not going to work.
Right. And another way to look at this too is you want to look at so your Social Security benefits, which we talked about. So figure out what that benefit's going to be. Go to SSA.gov to figure that number out, and then look at any pension amounts that you might have. And then you add all those figures up. So maybe if your Social Security and pensions, if you're married combined, and let's say it's $50,000, then look at how much money have you saved. You have $100,000 saved. Okay, well, that's $4,000. So your income, you don't want to spend any more than $54,000. So that's 4% on the $100,000 that you saved, plus the $50,000 that you have in pensions and Social Security, 54. If you're used to spending a lot more than that, you will go broke. So you got to be careful. So again, this is just kind of easy steps just to see how much money that you have, and then creating the income is such a totally different part of the game, which we'll get into a little bit later. But we're running to the end of the clock. We got to take another break. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al Clopine. Happy holidays. Happy New Year, everyone. We're talking about some steps here to get you prepared for retirement. Maybe 2017 is your year that you want to retire. Are you prepared? We talked about looking at getting your Social Security strategy in order. When are you going to claim it? 62, 70, 66, or anywhere in between? Then we looked at, all right, well, how much money do you need?
Yeah,
right?
Evaluate your savings. And the next one I would say is track your expenses. And a lot of people just assume they're going to spend less in retirement. And we find in many cases it's the opposite,
right, particularly
in the first years of retirement, because there's more time for leisure. Hopefully you still have your health, more time for travel, this sort of thing. And things that you want to do around the house that you haven't done, you put off, now you go ahead and do them. We find a lot of people spend a little bit more, but you got to start with what you're spending right now. And in this article, it says, write down every cent you spend in a month and evaluate the results.
No one will ever do that. That is ridiculous.
Which is good.
That is just stupid.
That is correct. That's an optimum, but let's talk reality, which is this. The reality is you get paid $100,000 and you're netting $70,000. Okay, and then
how much you got left?
How much you
Zero.
have left at the end of the year?
You're spending 70.
So did your savings go up or down? Well, I don't have any savings, and it didn't change. Okay, well you're spending $70,000.
Right. Look at your net paycheck.
Yeah.
Right. If there's something left,
you're spending less. if there's, in some cases, some of you are spending all of that plus more. By how? By putting it on credit cards.
I would say the most successful individuals financially don't budget like that. They do not track every cent.
Yeah.
I mean, I'm not taking anything away from you engineers that have your spreadsheet that you
right.
update it every second. But I just think that the wealthiest, the most successful that I have found in almost 20 years of doing this, had an automatic way to make wealth, right? Because they paid themselves first. Right? They figured out, all right, well, here, I need to save X amount of dollars to hit whatever financial goal that I'm shooting for, and I will save those dollars, and then I will spend everything else. And guess what? They hit those goals.
Right.
The other people, they're spending every day tracking their expenses, and they're saying, you know what? We don't have any money to save.
It's all gone.
It's all gone.
It's funny, huh?
So let's do it again next week. Let's do it again next month, right? Next year.
Well, I think you hit on something that's absolutely critical, which is pay yourself first. And by that, you're saving first before you're spending. And the easiest way to do that is if you have a 401k or 403b at your work, because it comes right out of your paycheck and you never miss it.
Right.
But not all of you have 401ks. So in that case, you're going to have to set up your own savings account. What I might suggest, in some cases, employers will put part of your pay right to a savings account. In other cases, it just goes right to your checking account if it's direct deposit, and you can have an auto withdrawal each month on or whatever date of your pay happens to your savings account. This can happen. If you make it automatic, it's going to happen. If you don't make it automatic, I can pretty much guarantee it's not going to happen.
Well, it won't, because you'll spend it.
Right.
Right?
Because it's there.
It's there.
Yeah, it's too hard not to.
It's like, oh, well, it's right there.
And by the way, we live the Southern California lifestyle, which is not exactly inexpensive.
Right.
And if it's there, we will figure out
a way to
how to spend it.
But if it's saved and you're disciplined, so I think, a lot of people have this as their New Year's resolution. Hey, I want to get on track for whatever financial goal. I want to get my finances in order and everything else. This is just one really easy way to do it. Automate your finances. So if you're dreading, right, to say, oh man, I really don't want to sit down and track every penny. Yeah, I get it. No one wants to do that. But if you say, you know what, we're saving, let's say, $10,000 a year. Maybe it's 5 or maybe it's 50. Increase that number. Right? Start with baby steps. And then lo and behold, guess what? If it's out of sight, out of mind, then you can adapt your lifestyle from there.
Right.
But you have to start. You have to get disciplined and say, you know what? This is what we need to do, and then get her done. Because how many times have we seen people with several $100,000 salaries in their 50s and 60s that have nothing saved.
It's shocking. Actually.
Nothing saved.
Yeah.
You're 60. You make $300,000 a year. You have nothing saved.
Right. And then
now is the time to start.
Right. And then we see school teachers. I mean, I'll kind of give them a little credit because by and large that group of individuals does a great job. Not only do they have a good pension from the school district, but they tend to save as well. And a school teacher with a $50,000, $60,000, $70,000 income, $40,000 income, doesn't really matter. They've got all this saved, plus they got a pension that probably covers 75%, yep, whatever, of their pay. So they're in great shape.
Right.
It's not how much you make, it's the discipline that you have along the way. But Joe, if you're about to retire and you've just gone through this mathematics that we mentioned last segment, which is, all right, I'm making $100,000 a year after taxes at $70,000, so I'm spending $70,000. Social Security is going to be $30,000. I got $500,000 in the bank, which will, if 4% rule means I can spend about $20,000 of that. I get 30 plus 20. I can only spend 50. So if you want to retire, in the next 6 months, why don't you try living on $50,000 right now, right before you retire, and see if you can make it work.
Right.
And if you can make it work, congratulations. Go ahead and retire. If you can't, then you will know you need to work longer because you're not ready yet.
Yeah, and I think then people will shotgun their retirement too. It's like, all right, well, here, we have this in savings, but I'm done. I don't want to work. So then they take on too much risk in their overall portfolio to try to generate a higher rate of return, where they realize, yes, I could lose, but they're so short-sighted, is that, well, I need this money to grow, and so I'm going to take on the extra risk until it's too late, and then all of a sudden that $500 now is $300.
Right, exactly. So here's another one, Joe, is understanding tax ramifications. And I think this one is missed a lot because you may not even realize this, but all the money that you've saved into your 401k or your 403b, or in many cases your IRAs, that money comes out. When you pull it out, it's income. It's all income. It's taxed at ordinary income rates, which is the same rates that you're used to paying right now. You thought you were going to be in a lower tax bracket? Well, I got news for you. If you're making $100,000 and you're netting 70, by the time that you cover all your expenses, because your income is going to come from your 401k plus Social Security, plus maybe you got a pension plan. Well, if you want to have the same lifestyle, you're going to basically be in the same tax bracket, because you're going to need to make $100,000 to be able to spend 70, and it's the same bracket. And boy, if people would just think about this, they've heard about asset diversification, right? You don't want all your eggs in one basket. You want to have stocks and bonds. You want to have domestic and international, small companies, large companies. I think people get that. But tax diversification, hardly anyone talks about that, because there's more than just ordinary income type of assets, which is a 401k IRA. There's your non-qualified account, which is your non-retirement account. You can invest that for growth, capital gains. That's taxed at a capital gain rate, which for most of you is 15%. It's a lower rate. Or Roth IRAs, how about them? You take money out of a Roth IRA, you pay no tax at all. So if you can start rearranging your assets and being careful about getting more money into a Roth IRA, making sure that your assets that are invested outside of retirement are tax efficient, then through retirement, Joe, you can end up with a lot more money in your pocket.
I guess that's a delayed gratification again. Is that, all right, well, here, should I put money into a Roth IRA? Don't get the tax deduction today, but all that money grows tax-free, right? But I swear to you, most of our clients that have a lot of money in Roth IRAs, they're not saying, damn, I wish I would have got that tax deduction 10 years ago. You know what I mean?
Yeah, right.
It's so far out of sight, and they're like, they are ecstatic that they got several $100,000 in a tax-free account that they can draw from and never pay taxes on those again.
Yeah, and so you think about that. So they'll have Social Security. Well, that's taxed at ordinary income rates. Up to 85% of Social Security is taxable. And maybe they have pension, maybe not. Maybe they still have money in 401ks. But they've done some real good tax planning to get money into Roth IRAs because they've realized that they have some control over paying taxes in retirement. And in fact, because you're creating your own income stream, you have more control over taxes in retirement, actually more so than any other time in your life. And it's not being talked about enough, Joe. People need to understand that they do have control over the taxes in retirement. And it's by putting together a forward-looking tax-efficient strategy. Find out how you can legally pay fewer taxes than before with our brand new personalized tax reduction analysis, updated for 2017.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Alan Clopine.
Hey, Joe, we've been talking about retirement checkup, and I think it's a good time to be thinking about such things. The new year, it's time to focus on the future. Let's get ourselves in shape, let's eat better, and let's make sure we got our finances in order. What a better time to do a retirement checkup, and what are the things that you need to be doing and thinking about before you retire, especially if you're maybe within 5 years of retirement or sooner. And we talked about Social Security strategies, evaluating your savings, tracking your expenses, understanding taxes. Here's another one, though, which is test out your plans. If you're envisioning a retirement filled with art lessons, golf, volunteer work, choral singing, that's on your list, I'm sure, Joe. Well, try those activities now to see how much you like them.
Right.
Because maybe you won't like them that much.
Exactly.
Right?
You know, I mean, there's a lot of people that wanted to live abroad, right? Hey, I'm getting the hell out of the country. I'm going to live somewhere cheaper or whatever. And they've never been to the country.
Right. Yeah.
You might want to spend a couple of months there.
Yeah. Go ahead and take a nice extended vacation before you retire. If you have to, take a leave of absence, whatever, but go over and try it and see what you think. At least a month, but, probably more than that, probably 2 or 3 months to be, more ideal.
Yes. But then they're saying, well, I'm selling all my assets to do this, and I don't have enough money to do that trip.
Sure,
well, then you are probably not prepared.
maybe you don't want to do. Maybe at least go visit and just at least get a sense of what it's like. But Joe, this happens. I like Hawaii, and I've got a condo in Kauai. We go there all the time. We love it, and I could envision spending large chunks of the year there in retirement. But we talk to all kinds of people, and a lot of people move there because it's obviously beautiful. Weather's great. And some people say it's the best thing we've ever done. We're having a great time. But a lot of people say, yeah, this isn't what we thought.
We had a client that did that.
Yeah, and it's like, well, because we did a 1-week vacation, it was great. But when we live here, it feels
and then
differently.
I bought a condo, and now I got this condo that I can't sell, and...
Yeah, so it's just, you know what, you try out these things beforehand. And I think, as my dad used to say, he retired because he was doing so many things he didn't have time to work.
Right.
And I think that's a good motto to live by. I really do.
Yeah, exactly. You want to be in that camp where it's like, well, I don't have time to work if I wanted to.
Right.
Versus, I think, unfortunately, a lot of individuals that are retired are bored.
Yeah.
It's like, wow, what am I going to do today?
Yeah.
What's on the list here? And so getting those list of activities, finding that sense of self and maintaining that purpose is key.
Right. Another one that's related is setting yourself up for part-time work actually before you retire. And it may be with your existing employer. Maybe they have opportunities for you to work part-time. Not only can that help finance a retirement, but it gives you a lot of ancillary benefits like the social contacts and the keeping your brain sharp and the sense of purpose and all these things.
Well, I think coming up next we have a guest that's going to talk a little bit more about that.
Yeah, about getting back into the marketplace when you've been out for a while, I think.
Right.
Yeah.
So a lot of individuals will take a hiatus for a couple of years or something like that. And it's like, all right, well, now I'm in my 50s or 60s, and I want to get back into maybe corporate life or find that career. And so there's not a lot of resources to help you with. So stick around next segment. We will talk to the president of iRelaunch, which is kind of an exciting new program that was just launched. So.
Joe, here's yet another one. Get serious about relocation plans, meaning that if you're, and this is related to what we were just talking about, if you plan to move when you retire, find out how much you'll actually net for your house, how much will cost you to move to the new location. Spend as much time as you can in your new city. Do a little bit of advanced research. And it's funny, we talk to an awful lot of people that before they retire, they have these thoughts, I'm going to go live in Italy for 6 months, or I'm going to go live in Hawaii or Montana, whatever it may be. The reality is people almost never move. I mean, the stats are overwhelming. It's almost 90% of retirees stay in their homes.
Right.
Yeah.
Yeah. I mean, we did a webinar of looking at using home equity, to help provide for retirement income. Yeah. I mean, there's some aspects of it is like, all right, well, here, I built a lot of memories in my home. I don't necessarily want to sell it. I don't want to downsize because, I want to die in the home that I've raised my family in. But then others, too, it's like, well, here, you probably need the asset to live off of. I think more and more of you will need to use some of that home equity. And you can be pretty smart and sophisticated with it, with different tools and different types of planning, just to make sure that you're looking at, hey, can I utilize my entire net worth to create the retirement of my dreams?
Right.
And it's possible if you just kind of take a look at different aspects of maybe just a traditional, hey, I got this in a 401k and here's in my savings account, and this is my Social Security.
In some cases, it may make sense to refinance your loan. You better do that while you're still working, right? Because you need the income to qualify. In other cases, maybe a reverse mortgage might make sense for you, or in some cases, you want to do some of those home repairs that you've been putting off, and you need to borrow them. Well, again, borrow them while you're still working, because you that's when you can qualify.
Right.
Right.
And then, there's home sharing. There's also
we can get real creative.
Right. I'm seeing more and more of that.
You have an extra bedroom in your house.
Sure. So I can rent that thing out.
Rent out the room. Get a little extra income.
You got it.
Yeah. No, it's all good, Joe. I think yet the last thing I want to highlight is making sure you have the right investments for your portfolio, and we could spend hours on this one, but part of this is making sure that you've got a diversified, globally diversified portfolio made up of all kinds of stocks and bonds. How often do we see people that have maybe 10 stocks, and they're it's almost like gambling, and it's just you kind of want to shake them. It's like, this isn't how you want to invest your retirement nest egg. What if a couple of these companies go down? You've lost 20% of your portfolio. It's
the only
crazy
thing we can do is try to educate Al.
Right.
That's kind of where I'm at now.
Yeah, you're right.
It's right. People will do what they want to do, and they think, some individuals think they have it all figured out. And by all means, if you got it all figured out, go for it.
Yeah, right.
I can just tell you the pros and cons of what your current strategy looks like.
Right.
And as long as you understand that, then God bless you. It's your retirement. It's not mine.
Well, that's true.
It's your lack of assets, not mine. It's your lack of planning, not mine.
And one thing, like, let's say someone has a single stock, like Apple, for example, which could be the absolute best investment in the world and or the worst one,
right? Sure.
And that's the problem with a single stock, is the variability of returns is off the charts, right? You can become wealthy and you can lose everything, right?
Yeah, but it's everything reverts back to the mean, which I don't think people understand, is that if you're a very successful, profitable company, guess what? Other companies want to have a piece of those profits. So that creates competition.
It does.
And what does that happen to stock price? It brings it down.
Yes.
So then it's like, all right, well, here, this company is the forefront of everything. Yeah, it was, but that doesn't say it's going to continue to do it. The larger it gets, the more tough it is for you to continue to compete on a global basis.
Yeah, just ask Microsoft. I mean, it's tough. Apple, kind of had a monopoly, and then all of a sudden,
ask J.C. Penney's.
Yeah.
How about Sears? Right.
Yeah.
Kodak. The list goes on and on.
When I was young, we went to Montgomery Ward's.
Right. There was a Montgomery Ward's right down the street from my house.
No more.